Okay, good morning and welcome back, everyone, to another Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week we had a somewhat volatile week, starting off the week on a much more negative tone with regards to the fiasco, if you will, with the Japanese bond market and potential tariffs with Europe over Greenland that drove the market substantially lower here at the beginning of what was a short week, only for the week to end on a fairly positive note here. With the exception of perhaps Intel's big earnings announcement last week, where the stock plunged roughly 17% after hours on the news that while the turnaround for Intel is seemingly starting to take hold, it's just not quite there enough to satisfy sort of the expectations after what has been a strong year for Intel last year. But overall, you see the markets recover at the end of last week, including some of the major tech names that have largely lagged behind the broader markets over the last 2 to 3 months. We had Nvidia and Microsoft and those types of companies perform quite well during that time frame yesterday. The economic data, if you look at jobless claims, came out slightly better than expected. You see the PMI starting to show some signs of rising costs with the PCE index. So this is all at the moment fanning concerns around whether or not we are going to get this soft landing that the markets were hoping that we would see with regards to economic data, which is essentially some slowing down of the overall economy while keeping inflation in check. This is most notable in the 10-year yield. You have, despite the fact that the Federal Reserve has cut interest rates, the 10-year yield has only climbed since that has happened. This really reflects the concerns that bond investors have with regards to just the general sustainability of the amount of debt that the US government is carrying, versus also the short-term fiscal responsibility that the bond market is pricing in with regards to the overall market. And the higher interest rates is really providing a headwind here for equities at the moment. The one, I would say, positive thing that we see here in the market right now is the fact that market breadth has continued to improve over the last 2 months. While the S&P and the Nasdaq have largely traded flat, the small caps, the equal weight S&P 500 index have actually done quite well in that period of time. So the rest of the market over the last 3 months have been really playing catch up and doing quite well. While if you just simply look at the S&P and the Nasdaq 100 index, you would think that the markets are flat and trading sideways, but it's not quite that way. It's actually just a few major tech names that have an outsized weight in the S&P and the Nasdaq 100 that have actually dragged those major indices down. So if you look at the S&P 500, we see we're still shy of that 700 level here on SPY, or 7,000 on the S&P 500. We're knocking on that door here. I think we'll likely get there here in the next few weeks. And when we get there, we'll likely power through that level, but it'll be more likely a slow grind rather than a quick move here to the upside, unless we start to see interest rates fall. And all eyes are on the FOMC meeting here this week. Largely, the expectation is for a quote unquote hawkish hold, where the Federal Reserve holds interest rates, but positions themselves for potential um, c- positioning, if you will, against the reacceleration of the U.S. economy because the labor market has cooled sufficiently in the last, call it 6 to 9 months. There are signs that that labor market cooling have started to stabilize. And the question is whether we stabilize or there's the concern that the markets or the from an economic perspective, we reaccelerate. If we do that, there's the there's the concern that inflation will likely come back as a result of it. And if that were to be the case, a potential raising rates again, which is something that the overall market is hoping is not going to be the case because if we have to raise interest rates, that would be, a fairly net negative here for equities. So the biggest concern that I have here right now is still with the fact that yields have risen. That 10-year yield above 4.2% is not a great sign here for equities, especially when you see gold and silver trading at such strong demand for safe haven assets like gold, silver, industrial metals. In that type of environment where everything is great, you generally don't see such strong demand for safe haven assets. So the fact that gold and silver continues to dominate headlines and performance here in the broader markets shows me that investors are overall concerned around the direction for the bond market and potentially the equity markets as well. So, right now, all eyes are on, what is going to be a big week for earnings. We have Microsoft, we have Apple, we have Amazon, we have the Fed interest rate decision here this week. We have PC inflation data, we have Q4 GDP data, a lot of data expecting to come out here this week that's going to help inform some of these questions that we have with regards to whether or not the US economy is cooling down sufficiently, or there are concerns that the overall economy can reaccelerate again. So, like I said, if you look at if you look at the S&P 500, we're just shy of that 7,000 level. But if you look at IWM, you look at RSP, if you look at the equal weight S&P 500 index or small caps, over the last month, both indices have been doing quite well here. If you look at the small caps, as you can see, we've seen a strong amount of performance here over the last couple of months. If you look at the equal weight S&P 500 index, you have a very similar chart here over the last couple of months. A strong performance here over that time that if you simply look at the S&P or the Nasdaq 100, you might not think performance is there, but we are seeing quite a bit of opportunity in, I guess you would call it the rest of the market away from, mega cap tech. And in the meantime, I think the biggest thing that is worth being aware of and concerned around is treasuries. You see this overall downtrend that we've seen in treasuries over the last couple of months. I'd like to see that, some stability here in the treasury markets and start to show signs of the market's moving higher here. That would be easing some of the concerns that we have with regards to interest rates. So that's where I would be focusing my attention here right now with regards to the macro theme. And then looking at individual ideas and understanding what's moving in this market. First and foremost, if you haven't noticed or you have to have your head buried in the sand to not notice, but gold and silver remain the top performing assets at the moment, whether you're looking at GLD, whether you're looking at SLV, whether you're looking at the miners through um, whether you're looking at the gold miners like Newmont Mining or Barrick Gold, or if you're looking at the copper miners like Freeport McMoran, all of these assets are doing uh, uh, incredibly well would be an understatement. Uh, we just have not seen these types of movements from precious metals or miners. Um, really ever, to be perfectly honest. But we're seeing just an insatiable amount of demand. And whenever we see an insatiable amount of demand, there's always a warning label that comes with that with regards to the risks with chasing this type of momentum and how that can play out. Because these types of parabolic moves will tend to see, a fair amount of volatility at the end of those parabolic moves. The question is not if, the question is when. So be very careful and be aware of that as you are likely in some way, shape, or form chasing some of that. Um, the next one I want to take a look at here is really more from an asset allocation perspective. The US equity markets have been, on paper looking fairly standstill for a couple of months now. We're seeing a lot more activity, a lot more performance out of the international stocks. So if you look at VXUS, which is the Vanguard International Stock ETF, you'll see that over the last couple of months, this index have been doing incredibly well. So as you're thinking about asset allocation perspective, you see that the U.S. markets, the U.S. equity markets that have been strong performance for multiple decades, are starting to show signs of lagging performance relative to the rest of the international stock community. And if you want to dig a little deeper here, you can look at you can look at EEM, you can look at any of the emerging market ETFs like the Vanguard VWO. All of these are seeing the same type of positioning here as well, where if you look at emerging markets, you look at Europe. Let's look at Europe, VGK. We're seeing a lot of this outperformance here coming from international stocks, from emerging markets, from Europe. So just simply from an asset allocation perspective, it's important to note that the US equity markets are starting to underperform, and we're starting to see better performance from the international markets at the moment. And then flipping over to looking at some of the individual companies that are outperforming here in this market, it'd be hard to miss what we're starting to see from the energy names. Whether it's ExxonMobil or Chevron, all of these companies have seen a substantial spike as a result of Venezuela, expectations that these U.S. companies will start, getting access and license to operate in Venezuela has driven valuations for a lot of these energy companies to historical highs. And that comes with a warning label as well. If you look at stocks like ExxonMobil, they're trading at pretty rich valuations relative to their own history. And at the moment, it hasn't translated into anything specific with regards to uh, profitability. We do see some strong EPS growth that's expected here for ExxonMobil, but they're trading at already rich multiples. So be a little bit more cautious on some of the oil and gas names that have started to show some performance here in the last week or so. One stock I want to take a look at here, which has been on our radar and it might be on many of your radars recently, is United Health. We've seen the healthcare stocks, over the last call it couple of months, continue to improve from a performance perspective, and we're starting to see a trend quality in the beginning of this year improve as well and look a lot more favorable to the upside. United Health does trade at a premium relative to its peers, but growth expectations have returned back to the high teens in terms of EPS growth. In terms of profitability, United Health has maintained sort of industry leading margins in this particular space. So the fact that we're starting to see growth, we're starting to see improvements of margins is really what at the moment justifies the rich valuation that we see with United Health. And we're looking to see if that plays a little bit of catch up here. Um, and United Health also reports earnings this morning. Ooh, it looks like the stock is down about 15% pre-market. So, um, it looks like they missed on both revenue. It looks like they missed on revenue. So, that's definitely one that at the moment probably is not as strong of a candidate. We have seen some big misses this particular earnings season. The next one to take a look at here is Lind. This is a chemicals company. They are not a household name by any means, but their industrial gases department has seen some strong demand, especially as a result of the strong demand we're seeing from an AI manufacturing perspective. If you look at the industrial gases required for wafer fabrication for semiconductors, those are highly specialized chemicals businesses, and companies like Lind specialize in those specific types of niches and verticals that allow these chemical companies to thrive in the market like we are in right now. Lynn trades at a premium relative to their industry, but it is expected to grow much faster, and more importantly, it's far more profitable. So the fact that it trades at 25 times forward earnings versus the industry median around 20 times is to some degree justified given the fact that it grows much faster and it's far more profitable than its peers. But you have quite a few of these chemicals giants, you can call it Lind, Lin, also Element Solutions, ESI. They deal with the chemicals for advanced chip fabrication. They also have an industrial gases and inks business that is specifically catered, for the semiconductor industry. So there are a few material names that I think are worth paying attention to here in this market environment. The next one I want to take a look at here is Gilead. Gilead continues to trade at a slight discount to the industry, but in the last week or so, it's really taken off here. And Gilead has been on our radar for quite some time, but it's just been a very slow grind here to the upside. We had Gilead on our radars back in the summer of 2025. But the price action after that initial interest in the stock kind of petered out. It was a very slow grind here to the upside. Just from a capital allocation perspective, we felt that there were better opportunities given just how slow Gilead was moving to the upside. But as you can see here over the last week or so, the stock really broke out here, and that's really where the opportunity lies. Their HIV franchise continues to outperform. They are far more profitable than their peers. They're trading at only 15 times forward earnings, even though they're expecting to grow EPS in the 25% year over year range. Their net profit margins are north of 25%. So when you have growth, strong EPS growth, strong profit margins, and only trading at 15 times forward earnings, that's really where I think Gilead represents some interesting potential upside. The next one to take a look at here is Comcast, the media slash broadband provider. Um, As you can see, Comcast recently completed, I guess you could call this bottoming formation after what has been a long period of underperformance. You have that bottoming formation started to break out here above 20, 27, 28. I'm sorry, 28, 29. Started to form that base, came back to retest that level of support, and is now starting to trade higher here. Comcast trades at 7 times forward earnings, but if you look at net profit margins north of 18% is quite attractive. It's not expected to grow very fast. A lot of these major media slash broadband companies are never expected to grow substantially. But given the fact that they are quite profitable, means that they have the ability to return cash back to shareholders in the form of dividends and share buybacks, and that's really where Comcast looks quite attractive, especially with a 4.3% dividend yield. The other one to take a look at here is CVS. Similar to United Health, CVS has started to break out here. It did well towards the second half of last year, and then in the last quarter, the stock really consolidated and traded sideways, and now we're starting to break out to new 52-week highs. We haven't quite reached that 52-week high, but we are within spitting distance of it. CVS trades at a pretty significant discount to its peers, about a 20%, 25% discount in terms of valuations. Even though the management team has provided guidance for 2026, and it looks like they could, it looks like if they do hit their guidance targets, that they will be returning back to those mid-teens year-over-year growth, which would be quite encouraging because right now net margins are effectively zero. We're really looking to see them hit these milestones for 2026 and start improving those margins, and that would allow the stock to re-rate back towards, closer to 15, 16 times forward earnings, which is what the stock historically traded at for a very long time. It very much feels that the multi-year decline and the activist fight with CVS is starting to be in the rear view mirror, and investors are starting to look forward and seeing a more optimistic future here for CVS. Um, the other one I want to take a look at here is Motorola Solutions. We obviously, or many of us, are familiar with Motorola as a cell phone device manufacturer from the call it the I guess the 90s and the 2000s. That obviously as a business no longer exists because of Apple. That completely ate their lunch in that particular space. However, Motorola Solutions has carved themselves out a nice business in the professional devices market. This is in the form of things like body cams for military and police and security purposes, as well as radio communications for for police and that category of users. And we've seen a strong amount of demand for those types of products, and Motorola Solutions, after what has been a multi-year decline here, is starting to show some signs of stability. You can see this decline that started in 2024 when this is a $500 stock. The stock shed, nearly 40% of its value here in the last year, but started to show some life here in the last few weeks. And that's really where we're looking for a potential continuation higher here. Motorola Solutions trading around 24 times forward earnings. Growth expectations are, I would say, pretty much in line with the industry, but they are far more profitable than in their peers. And that's really where I think the upside opportunity comes for Motorola Solutions, trading at around 24 times forward earnings. Like I said, this week is a big week for earnings. You've got Boeing, you've got the defense stocks. You have RTX, you have Northrop Grumman, you have Starbucks, you have Microsoft, you have um, American Express, you have Apple, you have Visa. You just have so many names that are reporting this particular week. You have Meta, Tesla. So big names coming up this particular week. A lot of them are sort of the latter half. We're talking Wednesday, Thursday that are reporting. So be on the lookout here for potential opportunities as a result of the earnings season kicking off into full gear this week. With that, that covers what I wanted to share with you here today. I hope this gives you a good understanding of what we're viewing right now from a macro picture perspective, and give you a good understanding as to what's moving in the market, where there are opportunities, where there are risks that you might want to avoid, but keeping you abreast of what's moving so that you don't miss out on potential moves from either a specific theme or a specific company. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.